Hello traders, I'm not traders. So in this video, I'm going to be explaining, in this video, we are going to be learning how to avoid FOMO in trading, right? So what FOMO simply means is that fear of missing out in a trade, right? It simply means like you have already analyzed your chart and you wait for your setup, you have seen the perfect entry, but you are afraid you are afraid of entering that trade. That's what FOMO simply means, fear of missing out on the trade. You are afraid that maybe if you enter the trade, you are going to hit stop loss, or the market is going to go against you, or the analysis you do is incorrect, or the setup you see is fake, or any other obstacle you might be thinking of that moment. That is fear of missing out, right? It's really mean FOMO. So in this video is going to guide you through on how to overcome that, right? So enjoy the video. Don't forget to follow my account, and you can also join my trading community, link in the bio. And I, as a trader, I trade with a robot called Sonuke AI. So if you're interested in it, I'm going to give it for free. I share it for free in my community. So if you're interested, you can also join my community and drop your comment about this video, what you learn, what you observe. See you guys in my next video.
When you look at a chart and see those strong momentum candles pushing up one after another, it may look like simple price movement. But in reality, it is much more than candles moving on a screen. What you are actually seeing is large amounts of money moving through the market. And this is usually the moment when many traders experience FOMO, the fear of missing out. You start thinking, I wish I had entered earlier so I could profit from this big move. But professional traders don't chase candles. Instead, they understand what causes that sudden spike in price. And for you to understand it, stay till the end of this video. The truth is simple. Most rapid price movements are driven by liquidity. When enough liquidity is taken from the market, price can move very fast in one direction. But this raises an important question. How is this liquidity created in the first place? Let's break it down. Large institutions operate with massive capital. Because of the size of their orders, they cannot simply enter the market with all their money at once. If they did, they would immediately move the price against themselves. So instead, they begin with a process called accumulation. During this phase, institutions slowly build their positions over time. When aggressive retail traders enter the market with strong buying pressure, institutions absorb those orders. This process is called liquidity absorption. If you want to understand this concept deeper, you can watch my previous video where I explain the liquidity absorption and early entry. Now here is where it becomes interesting. Price doesn't just jump randomly, it explodes when multiple forces align at the same time. First, price reaches a zone filled with liquidity, above highs or below lows, where stop losses and breakout orders are waiting. At that moment, both higher timeframe liquidity and lower timeframe liquidity are swept together, releasing a surge of orders into the market. At the same time, there is often little to no opposing force. Buyers may be aggressive, but sellers are scarce, or vice versa. With no resistance, price has no choice but to jump quickly to the next level where orders exist. Then comes institutional and algorithmic execution. Large players don't move slowly when conditions are right. They strike with speed and volume, injecting powerful momentum into price. If this aligns with news or a strong market catalyst, the effect becomes even more explosive. Perception shifts instantly, and massive orders flood the market all at once. Now everything connects. Liquidity gets taken, stops are triggered, new traders jump in, others get trapped, and their losses become fuel. This creates a chain reaction where price feeds on itself, moving faster, stronger, and more aggressively. That is why a spike is never just one thing. It is a moment where liquidity, imbalance, lack of opposition, and momentum all collide at once. And when they do, price doesn't move normally, it erupts. So how can this help you build a strategy? When all these liquidity, momentum, imbalance all align together, then look for a little pullback and enter for a high profitable win. As you continue following my videos, you will gradually learn how to recognize liquidity pools, market imbalances, and institutional footprints directly on the chart. These are the principles that help traders make clearer decisions and approach the market with confidence. So if you truly want to understand how price moves and learn how to spot high probability opportunities before the crowd sees them, make sure you follow for the next lesson.